they force trades, and the market punishes them for their impatience. You can't force profits out of a market that's not ready. You can only position yourself so that when it is ready, you're calm, clear, and confident enough to act. That's what precision really means, readiness. It's not about guessing the next move. It's about being perfectly prepared for it when the signal comes. It's like hunting. You don't chase the animal through the woods. You wait quietly until it comes into range. The shot you don't take is often the one that saves your ammunition for the opportunity that matters. Now, trading less also means studying more. The fewer positions you take, the more time you have to analyze each one properly. You start noticing the fine details, how a stock behaves before breaking out, how volume builds quietly before a move, how price reacts to key levels. Precision is born out of observation. You can't see those details when you're constantly in and out of trades. You're too distracted, too emotional, too reactive. You remember what I said in that earlier talk on the rule that prevents losses, that your first job is to protect your capital. Well, trading less is another form of protection. Every trade you avoid that doesn't fit your criteria is a trade that saves you money. The best traders don't just manage risk when they're in a position, they manage it before they even enter one. They understand that doing nothing is often the most profitable decision they can make. Do you know what overtrading really signals? A lack of conviction. When you're uncertain about your edge, you compensate by taking more trades, hoping that the law of averages will bail you out. But that's not trading. That's gambling with better lighting. Precision means you wait until the odds line up in your favor, when price, volume, and market tone all speak the same language. That's when you act decisively. You don't hesitate. You don't doubt. You move with conviction because you earned that conviction through patience. The beauty of trading less is that it sharpens your emotions. You stop being numb to losses. Every trade matters again. When every trade carries weight, you treat it with care. You plan it. You set your risk, define your exit, and monitor it with attention. That kind of focus is what separates real traders from the crowd. Most people lose not because they lack knowledge, but because they spread themselves too thin, too many trades, too many distractions, too little control. Ask yourself this: what if you took only 5 trades this month, but each one was chosen with surgical precision? You'd watch the market differently. You'd study every angle, test your reasoning, and wait for the market to confirm your idea. Your win rate might not jump overnight, but your consistency would. And consistency is what makes wealth in trading. It's not the one big win. It's the repeated execution of a sound process. There's another hidden advantage to trading less: emotional endurance. Every trade you take drains a little bit of your focus, a little bit of your mental energy. Too many trades, and you start trading on fumes. That's when mistakes multiply: missed stops, impulsive entries, poor position sizing. Precision trading keeps you mentally fresh. You're not reacting to every tick. You're observing, thinking, and waiting. That kind of composure can only come when you're selective. And the irony is, the less you trade, the more you tend to make. Because when you wait for only the cleanest setups, your trades align better with the market's natural rhythm. You enter with the trend instead of against it. You exit with discipline instead of emotion. You stop fighting the market, and you start moving with it. That's precision, the harmony between your actions and the market's intention. Trading less also helps you see the bigger picture. You stop obsessing over every tick and start thinking in terms of waves, cycles, and probabilities. You stop being a day-to-day speculator and start becoming a strategist. And when you view the market from that height, the noise fades. You're no longer chasing opportunities, you're letting them come to you. The market rewards patience because it punishes impatience. Every great trader I've ever known had one thing in common: they knew when not to trade. They could sit in cash for days, even weeks, without feeling the itch. That's because they understood that their real edge wasn't in predicting the next move. It was in waiting for the right moment to act with total precision. Trading less, then, isn't about doing nothing. It's about doing the right thing at the right time. It's about quality over quantity, conviction over noise, and clarity over activity. Missing a move is cheaper than forcing a bad trade. Every trader knows that pain, watching a stock take off without you, climbing point after point while you sit on the sidelines. You feel that pull in your chest, that whisper that says, "I knew it was going to move. I should have just gotten in." But that whisper is the market's most dangerous voice. It tempts you to chase, to act after the move has already begun, to trade not because of a setup but because of emotion. That kind of thinking has emptied more accounts than bad analysis ever has. I've missed plenty of moves in my life. Some were big, the kind that make headlines. But I learned early that missing a move never ruined me, taking the wrong one did. The market is full of opportunities. There's always another setup, another signal, another chance. But there's only one capital base, and once it's gone, the game's over. The cost of regret is temporary. The cost of a bad trade can last a lifetime. Let me ask you something. How many times have you jumped into a stock just because it started running and you didn't want to miss out? You probably told yourself, "It's already moving, I'll just grab a piece of it." And what happens next? The moment you buy, it pulls back. You watch your entry go red, and suddenly you're hoping instead of trading. You start telling yourself you'll hold until it bounces, but the bounce never comes. That's not a trade, that's a trap. The professional trader doesn't fear missing out. He fears losing control. He understands that trading is about waiting for confirmation, not reacting to movement. Prices move every day, that's their job. But the market only offers a few real opportunities where the odds are in your favor. If you miss one, it doesn't matter. There will always be another one. The only thing you lose is the illusion that you needed that trade. When you force a bad trade, you're not just risking money, you're damaging your discipline. You're telling yourself that your rules don't matter, that emotion gets to call the shots. And once you cross that line, it gets easier to do it again. One emotional trade leads to another. Before you know it, you're no longer trading a plan, you're trading your frustration. The market doesn't need to beat you at that point. You've already beaten yourself. There's an old truth I've seen play out countless times. The trades you miss won't hurt you nearly as much as the trades you shouldn't have taken. Missing a trade is an opportunity deferred. Taking a bad one is capital destroyed. And in this game, capital is time, it's your future buying power, your ability to stay in the game long enough to win. Once you understand that, you start valuing patience over participation. You remember in the earlier video, we talked about the rule that prevents losses. That rule was your shield. It kept you from bleeding capital when emotions ran high. This principle builds directly on that. Missing a move is an act of protection. It's your way of keeping that shield up. It's saying, "I'll pass on this one because my edge isn't clear." That's not weakness, that's strength. Every professional trader lives by that code. Do you know what separates a trader from a gambler? The trader waits for alignment between price action, volume, and market context. The gambler acts on impulse. The trader might miss 10 moves before taking one, but when he takes it, he's positioned with confidence. The gambler takes 10 trades and hopes one works. That's the difference between consistency and chaos. Missing a move teaches you patience, but forcing a bad trade teaches you pain. And pain leaves marks, emotional marks that linger long after the loss is gone. You start hesitating on good setups because the last impulsive one burned you. You start second-guessing your own strategy. That's how overtrading begins, trying to make up for what never should have been lost. The truth is, no one ever went broke sitting on the sidelines. You can't lose money by waiting. The hardest part is accepting that waiting is still part of the job. The market doesn't care that you're bored or that you missed the move. It doesn't reward neediness. It rewards precision and patience. When you learn to be okay with missing out, you start trading from strength, not from fear. Let me ask you again, which costs you more, missing a move or forcing one? Most traders know the answer, but they don't live it. They'd rather be in something, even if it's wrong, because they can't stand the feeling of watching a chart run without them. That's not trading logic, that's ego. The market has no room for ego. It will strip it from you one loss at a time until you either learn humility or quit. Every time I waited for the market to come to me, I made money. Every time I chased a move, I paid tuition to the market. That tuition isn't just dollars, it's time, energy, and confidence. The more you chase, the more the market teaches you the same lesson patience pays, impulsiveness costs. You can't force profits out of timing that's already passed. You either catch the move from the start or you let it go. And the irony is, most of the moves you miss wouldn't have worked out anyway. The chart might look perfect in hindsight, but live trading isn't hindsight. Prices whip, fake, and trap. The moves that look smooth after the fact usually weren't so smooth in real time. Missing them spares you the frustration of being whipsawed by volatility that wasn't visible on the final chart. Precision comes from selective participation. You're not trying to be in every trade, you're trying to be in the right ones. When you learn to wait for your pitch, you stop swinging at everything that moves. You realize that your real power lies not in the trades you take, but in the ones you reject. That's where discipline grows, and where accuracy sharpens. Missing a move doesn't make you less of a trader. It makes you a trader with control. It means you're not ruled by emotion, not swayed by headlines, not pulled by the crowd's excitement. You're calm enough to watch opportunity pass, knowing that the market's next wave is already forming somewhere else. Defense protects capital. Accuracy multiplies it. That's the foundation of every great trader's philosophy. You can't make money in the market until you learn how not to lose it. The problem with most traders is they start in reverse. They chase profits before they understand protection. They think the secret lies in finding the next big move or the perfect entry, when in truth, it begins with the discipline to defend what you already have. Capital is your ammunition. Once it's gone, your accuracy doesn't matter because you're out of the game. Every trader loves to talk about winning, but the real professionals talk about survival. The market isn't a playground, it's a battlefield. You can't fire at every target. You have to preserve your ammo for the high probability shots. Defense is what keeps you alive long enough to take those shots. And when you do, accuracy is what turns survival into success. That's the balance one without the other collapses. Let me ask you something. Have you ever had a great streak of winning trades, only to lose it all on one careless mistake? That's what happens when defense is ignored. You can be right 9 times out of 10, but if the 10th loss wipes out the previous 9, you've learned nothing. Defense means you never let one bad trade ruin your week, your month, or your mindset. It means your losses are always within your control, never outside it. That control is your armor in this game. Defense isn't about fear, it's about respect for the market, respect for risk, and respect for the fact that no one, no matter how skilled, can predict every move. Every time you put a stop loss in place, every time you size your position correctly, every time you walk away from a trade that doesn't meet your rules, you're playing defense. And that defense builds the foundation that allows your accuracy to work when the right opportunity appears. Accuracy, on the other hand, is your offense. It's what multiplies your capital once your defense has kept it safe. But accuracy doesn't come from guessing right, it comes from choosing wisely. You wait for the market to line up with your conditions. You confirm direction through price action, volume, and behavior. You don't shoot at shadows, you wait for the target to step into the light. That's the trader's discipline, protecting capital while preparing to deploy it precisely. You see, there's a rhythm between defense and accuracy. Defense keeps you steady when the market's uncertain, and accuracy lets you strike when the picture becomes clear. You can't have one without the other. A trader with only defense never grows, he just survives. A trader with only accuracy gets reckless and burns out. The great ones master both. They guard their capital like misers and deploy it like marksmen. Do you remember the earlier video about the rule that prevents losses? That rule was all about defense, about making sure you never dig yourself into a hole so deep you can't climb out. What we're talking about now is the next step, learning how to build once you've protected. It's the same principle, extended. Defense keeps you in the game. Accuracy makes the game worth playing. You can think of trading like a two-stage engine. The first stage, defense, gets you off the ground. It's the fuel of discipline, risk control, and emotional restraint. The second stage, accuracy, propels you forward. It's the precision of your entries, the clarity of your timing, and the patience to let profits develop. Without the first stage, the second never ignites. Without the second, you never reach orbit. Most traders get this balance wrong. You know, every trader out there is looking for that one edge, that one small twist in the game that makes the difference between a losing hand and a winning one. And today, I'm going to talk about something that sounds simple, maybe even too simple, but it's the kind of simplicity that took me years to understand. This talk builds naturally on what we discussed in the previous video on rule that prevents losses, because before you can make your trades more accurate, you first have to make sure you're not bleeding capital through carelessness. Now, here's the truth. There isn't any trick in Wall Street that can beat patience, discipline, and observation. But there is a simple trick to improve your trading accuracy, one that separates the guessers from the professionals. It's not about fancy indicators or complex algorithms. It's about learning to sit still until the tape shows its hand. I don't mean sitting idle out of fear. I mean waiting because you've read the market's tone and you're letting it confirm your judgment. Tell me, have you ever jumped into a trade just because you felt the move coming, only to watch it reverse the moment you press the button? Every trader's done it. That's human nature. We want action. But the market doesn't reward excitement, it rewards clarity, and clarity comes from preparation. When I say simple trick, I mean developing the habit of confirming your idea through price behavior, not your emotions, not your gut, not the headlines. The tape never lies. You can lie to yourself all you want, but that ticker will always tell you the truth if you know how to listen. You might think it's going up because the news looks good or because a friend says it's a sure thing. But if the price action doesn't agree, you're already on the wrong side of the trade. You see, the key to accuracy is alignment, the alignment between your reading of the market and the actual behavior of prices. Before I ever took a position, I waited for the market to confirm my thinking. The amateur guesses, the professional waits. That's the trick. You let the market show its strength before you risk a single dollar. Now, here's something most traders overlook. Accuracy isn't about being right more often. It's about losing less when you're wrong. Think about that. A trader can be wrong half the time and still grow rich if he controls his losses and lets his winners run. So when I say improve your accuracy, I don't mean chase perfection. I mean learn to eliminate the poor trades before they happen. Accuracy is selective participation, picking only the spots where the odds favor you. Do you remember the feeling of watching a stock climb without you wishing you'd bought earlier? That's greed whispering in your ear. But a real trader knows that missing a move is cheaper than forcing a bad one. You want accuracy, then stop needing to be in every trade. The market's always there tomorrow. Let's connect this back to what I said in that earlier talk, the rule that prevents losses. That rule was about protecting your stake, because survival comes before profit. What we're discussing today builds right on top of that. Improving accuracy means you take fewer shots, but each one cleaner, clearer, better aligned with the market's rhythm. You're no longer gambling, you're acting with precision. Most traders don't fail because they lack information. They fail because they act too soon or too often. They want the market to confirm them, instead of the other way around. But a trader's job isn't to predict, it's to react correctly. When you stop needing to prove yourself right and start letting the market prove itself, your accuracy shoots up almost overnight. Here's another question for you. Do you track your trades? Really track them. Not just the profits, but the patterns, the setups, the times you felt impatient. Because if you don't, you're flying blind. A trader's logbook is worth more than any signal service you'll ever subscribe to. I used to write down every trade, what I saw, what I thought, what the market did afterward. Over time, I started seeing patterns not just in the tape, but in myself. That's when accuracy began to sharpen. You have to know your own weaknesses as clearly as you know your charts. Maybe you trade best in trends and poorly in choppy markets. Maybe you lose focus after 2 trades. Maybe you chase when you're bored. Those details, those are your real trading indicators. The market doesn't change much, the players do. So your biggest trick is to know your own game better than the market knows you. Now, don't mistake this for overanalysis. You can't let hesitation paralyze you. When the setup matches your plan, and the price confirms your direction, then you act, no hesitation, no second guessing. The simple trick isn't about doing more thinking, it's about doing the right waiting. Some traders ask me, Jesse, how do you know when the price is right? I tell them, you don't guess, you watch for behavior. Watch how the stock reacts after a breakout. See if it holds its gains or slips back under resistance. Watch how it trades when the market turns soft. Strong stocks act strong. Weak stocks crumble. That's all the confirmation you need. And here's a secret, most of your accuracy comes from staying out of the market. That's the part no one likes to hear. The biggest profits are made in the sitting, not the trading. The simple trick is the art of waiting for your pitch. The market's job is to throw distractions at you, rumors, spikes, reversals. But your job is to stand there, watch them pass, and only swing when the odds are stacked in your favor. You'll find, over time, that the fewer decisions you make, the better they become. Trading isn't about constant action, it's about selective precision. You don't measure success by how many trades you make, you measure it by how many you avoid until the right one comes along. And if you remember the principle from that earlier video, the rule that prevents losses, you'll see how it ties perfectly here. That rule was your defense. This one is your aim. Defense keeps you in the game, accuracy takes you forward. One without the other is useless. So, before you place your next order, ask yourself, has the market confirmed my idea? Or am I just hoping it will? Because hope is the costliest emotion in this business. The moment you stop hoping and start waiting, you begin to trade like a professional. Every great move I ever made came after the market told me it was time, never before. Accuracy means losing small, not being right always. Most traders never understand that, and that's why they fail. They believe trading is about prediction, about calling tops and bottoms, about proving how smart they are. But the market doesn't care how often you're right. It only cares about how much you lose when you're wrong, and how much you make when you're right. That's the difference between amateurs and professionals. The amateurs chase perfection, the professionals chase survival. Now, let me ask you something. How many times have you had a trade that was wrong, but you refused to admit it until it became painful? Everyone's done it. You tell yourself it'll come back, that it's just a shakeout, that you'll give it one more day. That's not trading, that's hoping. And hope is poison in this business. The market doesn't punish you for being wrong. It punishes you for staying wrong. The whole secret of accuracy is knowing when to cut. When I was trading in my early days, I wanted to be right on every position. It bruised my pride to take a loss. I'd add to losers, double down, tell myself I knew better than the market. That arrogance cost me fortunes. It took years and several hard lessons before I realized that accuracy isn't measured by the number of correct predictions. It's measured by how well you control damage when you're wrong. You can make mistakes all week and still end up profitable if your losses are small and your winners are allowed to breathe. A trader who wins 40% of the time but cuts losses quickly will outperform the trader who wins 80% of the time but refuses to take a small hit. Why? Because the first trader plays defense like a hawk. He understands that trading is a game of capital preservation first and profit second. He doesn't waste time defending a bad trade. He steps aside, studies the tape again, and waits for the next high probability setup. That's real accuracy. It's the discipline to be wrong the right way. You might think, but Jesse, if I cut every trade that moves against me, won't I get shaken out too often? Maybe. But that's a small price to pay compared to getting buried in one trade that goes terribly wrong. The market will always offer you another chance, but it won't always offer you another bankroll. You can't control whether the next tick goes your way, but you can control your exit. And control is what keeps you alive in this game. There's a strange comfort in realizing you don't need to be right most of the time. It frees you from the pressure that ruins judgment. You stop trying to predict and start reacting. You start focusing on what the market is doing, not what you want it to do. Accuracy improves the moment ego steps out of the way. Tell me, do you know what happens when you stop defending wrong trades? You start seeing clearly. Your charts make more sense. Your analysis sharpens. Because you're no longer emotionally attached to your positions. The worst trades are the ones you fall in love with, the ones you can't let go of because you've convinced yourself they have to work. But nothing in the market has to happen. Prices don't owe you a return to break even. They just move, and if you don't move with them, you get left behind. That's why cutting losses quickly is not weakness. It's accuracy in motion. It's your way of aligning with the market instead of fighting it. Every time you cut a losing trade, you're making room for the next opportunity. You're staying liquid, mentally and financially. Liquidity is a trader's lifeblood. Lose it, and you're stuck watching, hoping, paralyzed. And remember what we talked about in that earlier video on the rule that prevents losses. That rule was about defending your capital, about staying alive long enough to play the next hand. What we're saying here builds right on that foundation. Losing small is the natural extension of that rule. You can't prevent losses completely, but you can make them manageable. You can make them part of your plan instead of part of your downfall. Most traders treat losses as failure. Professionals treat them as expenses. Every business has costs. Trading is no different. Your stop loss is the rent you pay to stay in business. You can't run a shop without paying rent, and you can't trade without taking losses. The trick is to keep that rent low enough so it doesn't eat your profits. Once you accept that, accuracy becomes less about prediction and more about precision. Precision means you don't waste bullets. You don't scatter your trades everywhere. You pick your shots carefully, and when they miss, you move on without hesitation. That's how you stay consistent. That's how you develop the confidence that separates the professional from the crowd. Because confidence in trading doesn't come from winning. It comes from knowing you can handle losing. Ask yourself this: would you feel comfortable taking 10 small losses in a row if it meant the 11th trade would wipe them all out and more? That's the test. Most traders wouldn't. They'd get emotional after the third loss, change their system after the fifth, or give up before the next opportunity. But the professional expects those small losses. They're part of his process. They don't shake him because he knows the math behind his edge. Accuracy to him is consistency in execution, not perfection in prediction. And when you trade that way, something powerful happens. Your emotions settle. You stop chasing revenge trades. You stop increasing position size to make back a loss. You stop needing the market to prove you right. Instead, you follow your plan. You take your small losses like a surgeon, clean, quick, and without regret. You let your winners run with calm confidence. Over time, your equity curve stops looking like a roller coaster and starts looking like a steady climb. That's the truth about trading accuracy. It's not a game of being right more often. It's a game of managing being wrong intelligently. The trader who masters that never fears the market again, because he knows exactly how much he's willing to lose long before he enters a trade. Trade less, but trade with precision. That's a lesson every trader learns the hard way, and usually after the market has taken its toll on their capital. You see, the instinct of most traders is to always be doing something, always buying, always selling, always reacting. They confuse activity with progress. But trading isn't about how many times you act. It's about how well you act when the time is right. The market doesn't pay you for movement. It pays you for timing. When I was young, I thought success came from being in the market every day. I believed the more trades I took, the closer I was to catching the big move. But I learned that the more I traded, the more mistakes I made. The market has a rhythm, and if you trade too often, you lose the ability to hear it. It's like trying to listen to a whisper in a storm, too much noise, too much excitement, too little clarity. Precision comes from calm observation, not constant action. Let me ask you something. How many trades have you taken out of boredom? You look at the screen, you see nothing special, but you still want to do something. Maybe you tell yourself it's just a small position, just to stay in the game. That's not discipline. That's restlessness disguised as strategy. Every unnecessary trade you make dulls your judgment. The best traders aren't those who act the most, they're the ones who wait the longest for the right setup and then strike without hesitation. Trading less doesn't mean you're lazy or scared. It means you respect the market enough to know when it's not offering an edge. Most of the time, the market is in noise mode, too many cross currents, too little direction. Professionals sit it out during those phases. They don't mind waiting because they understand that patience is a position, too. The amateurs, on the other hand, feel the need to prove something every day.